Hey, everybody. Wanted to jump on here real quick and talk about the topic of alternative investments. So, many people have probably heard of stocks and bonds, and they may have heard of investing in companies like Amazon and Apple and Google, and how all of that works to boost your retirement savings or money that you may have in a 401k. That is pretty common. It's very easy, it's a very barrier to entry, especially with some companies, like Schwab, Fidelity, Amazon, Robinhood, give you opportunities to invest and trade commission free. So, what else is out there in the world of investing? So, if you've got enough money saved up and you have some extra cash that you can look to deploy, what else is there you could potentially be invested in? What are some ways that you can diversify your account? What are some ways that you could potentially boost your retirement savings? So, this is where alternative investments come into play. And alternative investments, you can typically think of them in four different buckets or four different categories. The first being private equity, the second being hedge funds, third being private real estate, and fourth being private credit. So the reason why we say private is because these are not available to the public. You can't, as an individual, go and just buy these off of a website or place an order or trade for them. You have to either have an advisor or someone that is guiding you through and making these purchases available to you. So, what are these different categories? What are these different investments? So first and foremost, private equity. So private equity is probably the thing you hear of most commonly referred to. It comes up a lot when you hear of private equity funds or private equity firms buying companies. So more often than not, a private equity company will buy a company, they'll buy a business. They'll look to fix it up, so streamline operations, make some corrections, maybe bring in new management, maybe reduce costs, and then eventually, maybe it's 3 years, 5 years, 10 years down the road, they sell that money and they reap a pretty high return for it, hopefully. And then they deploy that cash back into buying other companies. So, private equity, you can mainly think about as buying businesses, turning them around, and then flipping them for a profit. Hedge funds. So hedge funds are a typical are another example. These are funds that may even buy publicly traded stocks and bonds. They may buy things like penny stocks or commodities or long short investments. What hedge funds do is they typically take on a greater amount of risk. So they are companies that are managed by private equity type firms, alternative managers, and they might only have two or three investments, and they invest heavily and they're heavily concentrated into those two or three investments. And that's what they're going to be investing in. So they're taking on a lot more risk. So hedge funds, even though they might trade publicly traded companies, they may only own a few of them. They may be highly concentrated. So those are different strategies that they look to beat the average investor with these hedge fund strategies. Private real estate, so pretty simple. They are buying, whether it be office buildings, industrial warehouses, rental properties, multifamily houses, apartment buildings. They're buying these and they're buying them in a public manner. So they don't ever launch as a private, as a publicly traded REIT. These are more so off the market and they're private real estate investments that you can put money into to raise the capital. And then they can take that money and they can go and buy private real estate on their own and hopefully generate good returns for their investors. And then lastly, private credit. So, what private credit is, these are people that are willing to lend money to businesses, to individuals, to whoever it may be, and give them a higher interest rate, typically charge them a higher interest rate than what a traditional bank will. So these are typically businesses that either cannot get approved by a traditional bank or they don't want to go through a traditional bank for their private financing. So they will go to these alternative asset managers, hedge funds, private equity firms, and look to get financing for their business. And what they're doing is they're paying a higher interest rate for that money, but typically no questions asked, a less stringent due diligence process for them, and then they're making so what these private equity firms are doing is they're making that private credit fund available to their investors, and that is another form of an alternative asset. So why do people typically invest in these? One, over the long term, it can help to boost your portfolio returns. And two, they're another form of diversification outside of traditional stocks and bonds. So there's a quick primer on four different types of alternative assets. There are some more, but those are just kind of the general ways, and kind of the four most popular ways are through private equity firms, hedge funds, private real estate, and private credit. Hopefully, you like the video. Make sure you hit the subscribe button. I will try to post relevant content to investors, and I'm mainly talking with business owners, entrepreneurs on ways you can grow your business and also grow your wealth, your personal wealth at the same time. Thanks. I hope you enjoyed.